You can have the most compelling business in the world with the most compelling thesis and growth trajectory, but if you don't hit these three prongs when discussing capital, no one's going to want to give it to you. I'm Arthur Petropoulos, managing partner of Hillview Partners. We're a middle market, lower middle market investment banking, M&A, capital advisory firm, helping companies generating about $1 million to $10 million a year in pre-tax earnings or EBITDA to find capital and sell their businesses. So, in the process of securing capital, you want to be able to crystallize the business. As we've always discussed, we talk about people, process, products. We talk about sales, fulfillment, operations. We talk about fundamentals, access, capabilities. But when it boils down to the dialogue, particularly around securing capital, there's three main prongs, three main things that you really need to hammer the drum on. And as a simple framework, we call it proof, promise, path. So if you think of the three P's relative to capital, and that's what we want to walk through in this video. So as it pertains to proof, that is, give some indication of track record as to how the business has historically utilized capital in a way that has been beneficial or advantageous to the providers of that capital. And that doesn't need to be the same type of capital that you're looking for in this particular iteration, right? You may be looking for a bank loan, and perhaps you've never had a bank loan before. You may be looking for outside equity investment in the business, someone to come and buy a large minority stake of the business, buy a majority stake of the business, and perhaps you've never done that before. But just because you haven't utilized that particular type of capital before or that particular structure does not mean you have not been a prudent steward of capital before, or an intelligent allocator of capital. And so really what you want to look for in the history of a business is in what other instances have we put capital to use where we've generated a good outcome. And if you're a business that's made any profit throughout the duration of its existence, you have that kind of proof. You can say, well, look, we self-funded the business from its founding. We deployed X dollars as we got the business going, and over time it's generated Y in terms of profit, both annual as well as on the aggregate. Every business that's profitable has proof of intelligent utilization of capital. It's just a matter of crystallizing that story. So the second prong is a promise. And so what are you really telling someone when you're asking someone for capital? You're saying, if you give us this capital, whether in the shape of equity, whether in the form of debt or credit, you're telling someone implicitly, we promise to take your capital and at some point in time, whether on the exit of a business for equity, whether in the repayment of a loan plus interest, we'll give it back to you with more. That's the promise being made. And you really want to think about how to specifically position that as well. So again, prong number one, here's proof of how we've utilized capital intelligently in the past. Prong two, we promise that if you give us X dollars today, we will give you Y dollars at this juncture in the future. And think about what that promise is. Think about what are the specifics. If you give us X dollars today in a debt, we will pay you back every year for the next 5 years with this level of interest. If you give us equity, we are planning on perhaps exiting the business in 5 to 7 years, at which case we want to give you back your capital plus 2 times more your capital, or whatever it may be. But don't just ask people for something without having a good indication of what you're ultimately going to give them back. Because the first question they're going to ask you when you ask them for capital is, what do I get out of this? What's in it for us? Why should we want to do this? The treasury yield gives us a guaranteed 4 to 5% of return every year. Why do we want to do this? And the answer can't simply be, well, we're going to pay you more than that, because there's a lot more risk. And so this leads us to prong number three of the path. And that is going to be, we have proof of historical utilization of capital. We have a promise that if you give us capital, this is how we plan on returning it to you. And the path is how we plan on, in this current iteration, allocating or utilizing the capital to generate a return on the capital from a business perspective such that we can make good for our promise of returning the capital with the upside that we've indicated. So again, I think a lot of people start with asking for money, having some vague idea of what they're going to do with it, and then some pipe dream of just how wonderful it may all turn out. But from our perspective, start with proof. Say, hey, this isn't our first time at the rodeo. We've done this before, and we've done it successfully. That's a good place to start. Second, if you give us this money, here's our structure that we are contemplating. Now, the person wanting to give you the capital may think differently and say, well, we'd prefer to allocate the capital this way. We'd like to deploy it this way. That's fine, but at least show that you've made the intelligent analysis or internal reflection, if you will, of how you would want to think about it in a way that's advantageous to the person giving the capital. And then thirdly, what is the specific path? We're going to buy this many more machines. We're going to develop this much more software code. We're going to offer these products. We're going to penetrate this market. Whatever the thing is, have a plan. So that way someone can say, well, they've done it before. They have an idea of what kind of capital they need and how it's going to come back to us, the investor. Here's a path of how they plan to do it. And so if you are the person, now put yourself in the shoes that you're requesting the capital from, they're going to feel comfortable. And it is comfort, it is the mitigation of risk that allows something to be intelligent. So say there's a 5% return from treasury bonds, from just putting the money into a money market account and getting interest back, and you are offering a 15% return per year for an equity investment, a 12% return for debt, whatever it is. There's that spread of 5%, 10%, 15%. If someone says, 20% return, and there's risk. And so someone says, am I getting compensated for the risk I am taking? And it is these three prongs that mitigate the risk, that make someone feel comfortable, as they should if you have these things chiseled out and crystallized, to provide the capital. And that's really what capital allocation comes down to. It's mitigating risk. It's saying, I am going to potentially earn some spread over the risk-free rate. What does that really mean? I'm going to earn some return better than the treasury bond, and in exchange for that compensation of the incremental return, I am going to take some added risk. If someone feels like they're getting paid well for the risk, or alternatively, if someone feels like they're not taking that much risk to get the incremental return, they'll be incentivized to do it. If someone feels like they're taking a ton of risk to get just a little more return, they're going to say, why bother? If I can get 5% return doing nothing, I'm not going to go pick up another 5 points from the train tracks waiting to get hit by a train. And that really comes down to these three prongs. So when seeking capital, let's recap the three prongs along this path. 1, proof. Have you intelligently utilized or allocated capital in the past? If you're a business that's generated profit and generates profit, then you have. You just have to figure out what that story is. 2, I promise. You want capital. What do you want this capital to look like? How will you give it back to someone? That may change. That may iterate in the dialogue, and likely will with some of the parties you're talking to. But if you've already thought about it, it shows that you are considering someone else's interest, not just what you want, but what you're willing to do for someone. 3rd, what is the path? How are you going to utilize the capital in this instance? How will it be allocated, delegated? What are you going to buy? What are you going to invest in? And how does that yield more profit and ultimately make good on the promise that you made? If you can clearly communicate these three things, it will very much help in the process of securing capital for your business. So that's the thought for today. Hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see everyone next time.